Before we dive in, please remember that I am not a financial advisor, mortgage lender, or real estate agent. This video is for educational and informational purposes only and should not be considered financial or legal advice. The information presented is based on regulations and data available at the time of recording and is subject to change. Always consult with a qualified professional, like a VA-approved lender and a trusted real estate agent, before making any major financial decisions. Let's get one thing straight right now. The VA home loan is not a handout. It is not a favor. It is, without a single doubt, the most powerful and flexible mortgage product available in the United States, and it is a benefit you have earned through your service to this country. Period. Full stop. But for millions of veterans, this incredible tool remains a mystery, wrapped in red tape and bogged down by myths that have been circulating for decades. Myths that cost you money. Myths that keep you renting when you could be building equity. Myths that make you think the American dream of homeownership is just out of reach. You see the ads. You hear the chatter. You know you're supposed to save 20% for a down payment, a number that feels like climbing Mount Everest in flip-flops. You hear about something called PMI, or private mortgage insurance, which is basically a penalty you pay every single month for not having that giant down payment. You worry about your credit score, wondering if that one late payment from 3 years ago is going to disqualify you. The entire process feels designed to make you fail. It's overwhelming, it's confusing, and it's discouraging. This video series is the antidote to that confusion. This is your complete battle plan. We are going to cut through the noise, debunk every single myth, and give you a step-by-step, easy-to-understand guide to leveraging the single greatest benefit you earned when you took that oath. By the end of this, you won't just understand the VA loan. You will be an expert, ready to confidently navigate the home buying process and secure the home you and your family deserve. We're going to talk about the myth that you can only use your VA loan once. That is absolutely false. We'll show you how you can use it over and over again, and even own multiple homes with it at the same time. We're going to destroy the myth that VA loans are slow and a hassle for sellers. In reality, they often close faster than conventional loans. We're going to tackle the myth that you need a perfect credit score, and the myth that the VA itself is the one lending you the money. But to truly understand the power of this benefit, you have to understand where it came from. This isn't just some random government program. This is a promise forged in the fires of World War II. Picture it. 1944. Millions of GIs are serving overseas. The country is holding its breath, praying for victory but also wondering, what happens when they all come home? How do you reintegrate an entire generation of warriors back into civilian life? The answer was one of the most transformative pieces of legislation in American history. The Servicemen's Readjustment Act, better known as the GI Bill. It offered education, it offered job training, and it offered the key to building generational wealth, a pathway to homeownership with the backing of the U.S. government. The goal was simple but profound, to ensure that those who fought to defend the American dream could actually participate in it. That promise, made to the greatest generation, has been extended and improved for every generation of service members since, from Korea and Vietnam to Iraq and Afghanistan. So when you hear VA loan, don't think of it as a complex financial instrument. Think of it as a promise. Thank you written into law. It exists to do 3 incredible things that no other loan can match. 1, to get you into a home with zero, and I mean zero money down. 2, to help you avoid paying that costly monthly PMI. And 3, to offer more flexible and forgiving credit requirements. These 3 advantages, the big 3, are what make the VA loan an absolute game changer. That zero down payment feature alone can save you tens of thousands of dollars up front. Money you can keep in your pocket for moving expenses, furniture, or your emergency fund. Avoiding PMI can save you hundreds of dollars every single month for years, drastically lowering your mortgage payment. So where do we begin? How do you unlock this power? It starts with one simple question. Are you eligible? This is the first gate you have to pass through, and for most it's wide open. The VA has clear guidelines. You are generally eligible if you fall into one of these main categories. First, veterans and active duty service members. If you've served on active duty for at least 90 consecutive days, you likely meet the requirement. For those who served during peacetime, the requirement is typically 181 days of continuous active duty. If you were discharged for a service-connected disability, you could be eligible even if you didn't meet the minimum service time. Second, members of the National Guard and Reserves. This is a big one where a lot of misinformation exists. If you have 6 years of honorable service in the selected Reserve or National Guard, you have earned this benefit. It's not just for active duty personnel. Your weekend drills, your annual training, it all counts. Third, and this is incredibly important, are certain surviving spouses. If you are the unremarried spouse of a service member who died in the line of duty or as a result of a service-related disability, this benefit may pass to you. It's a small way the nation recognizes the ultimate sacrifice made not just by the service member, but by their entire family. Now, proving you fit into one of these categories isn't just a matter of saying so. You need the official golden ticket from the Department of Veterans Affairs. It's called the Certificate of Eligibility, or the COE. Think of the COE as your official confirmation from the VA that says, yes, this person has met the service requirements and is eligible for the VA home loan benefit. A mortgage lender cannot, and will not move forward with a VA loan application without this piece of paper. It is non-negotiable. It is step one. So how do you get it? The great news is it's easier than ever. You don't have to spend weeks waiting for something in the mail. The absolute best way is to work with an experienced, VA-savvy mortgage lender. They have a direct, instantaneous portal into the VA system. In most cases, they can plug in your information, your name, social security number, date of birth, and generate your COE on the spot in a matter of minutes. It's that fast. If for some reason the online system can't automatically verify your service, or if you just want to get the document yourself, you can apply for it directly through the VA's benefits portal online, or by mailing in a form. You'll just need a copy of your discharge or separation papers, like the DD-214. But honestly, letting a good lender pull it for you is the path of least resistance. Getting that certificate of eligibility in your hands is a huge moment. It's the first tangible proof that this powerful benefit is yours to claim. But getting that certificate is just opening the door. The real power, the magic number that determines how much you can actually borrow with zero down payment, isn't just about being eligible. It's all about something the VA calls your entitlement. And understanding that one word is the key that unlocks everything we're going to talk about next. It separates the veterans who use this benefit to its maximum potential from those who leave its true power on the table. So let's rip the Band-Aid off. The word entitlement sounds, well, it sounds entitled. It sounds like a handout. And that's the absolute worst name the government could have possibly chosen for one of the most powerful financial tools you have ever earned. Because a VA loan entitlement isn't a handout. It's a handshake. It's a promise backed by the full faith and credit of the United States, made to you in exchange for your service. Here's what it actually means. Your entitlement is the specific dollar amount that the Department of Veterans Affairs guarantees to a private lender, like a bank or a credit union, on your behalf. It's not a loan from the VA. It's a guarantee to the lender. Think of it like this: you walk into a bank to get a home loan. The bank is nervous. They see you want to put $0 down, which is usually a massive red flag for them. But then you slide a piece of paper across the desk. It's a voucher from Uncle Sam. This voucher says, "Hey, Mr. Banker, if this veteran for some reason can't make their payments and the house goes into foreclosure, I, the U.S. government, will personally cover a portion of your losses." Suddenly, the banker's entire demeanor changes. The risk they were so worried about has been significantly reduced. That promise, that voucher, that guarantee, that is your entitlement. The government is essentially co-signing your loan, making you an incredibly attractive and low-risk borrower in the eyes of the lender. This is the mechanism that makes the whole zero down payment thing possible. Without the entitlement, the VA loan simply wouldn't exist. Now, this is where it gets really interesting and where most people get it wrong. Your entitlement isn't just one number. It's actually split into two parts: basic entitlement and bonus entitlement, which is also called Tier 2 entitlement. First, let's talk about basic entitlement. Every eligible veteran gets a basic entitlement of $36,000. Now hold on. I know what you're thinking. $36,000? I can't even buy a used car for that in some places, let alone a house. And you're right. That number is incredibly deceiving. You are not limited to a $36,000 loan. Remember, the VA doesn't guarantee the whole loan, just a portion of it. Historically, and what lenders still follow, is a guarantee of 25% of the loan amount. So do the math. If the VA guarantees $36,000, and that represents 25% of a loan, what's the total loan amount? It's $144,000. For many years, this was effectively the limit for a zero-down VA loan. If you wanted to buy a home for more than that, you had to put some money down. But that all changed. And this is where the real power comes in. Enter bonus entitlement. The government realized that $144,000 doesn't get you very far in places like San Diego or Honolulu or Northern Virginia. So, they created a second tier of entitlement. This bonus entitlement kicks in to help you buy homes in more expensive areas, again with zero down payment. It's calculated based on the conforming loan limits set by the Federal Housing Finance Agency, which change almost every year. These are the maximum loan amounts that Fannie Mae and Freddie Mac will buy from lenders. So what does this mean for you in practical terms? It means that as long as you have your full VA loan entitlement available, you do not have a loan limit. Let me say that again because it's the single most important myth we need to bust. For most veterans using their benefit for the first time, there is no VA loan limit. If you can afford the monthly payment on a $1 million home, and the appraiser agrees it's worth $1 million, and you have your full entitlement, you can buy that home with $0 down. The VA will guarantee 25% of that loan for the lender, no matter how high it goes. This is a game changer that puts veterans with good income, but little savings on a level playing field with conventional buyers who have to scrape together a 20% down payment. This brings us to the second biggest myth. You can only use your VA loan once. This is completely 100% false. The VA home loan is a lifetime benefit. You can use it over and over and over again. You can buy a home, live in it, sell it, and then use your VA loan again to buy your next home. When you sell the property and pay off the loan in full, your entitlement is restored to its full power, ready to be used again. But what if you don't want to sell? What if you get PCS orders and you want to keep your first home as a rental property and buy a new one at your next duty station? This is where things get really powerful. You can have more than one VA loan at the same time. This is possible because you can use your remaining entitlement. Let's walk through a simple example. Let's say the conforming loan limit in your area is $700,000. The VA guarantees 25% of that, which means your total entitlement, basic plus bonus, is $175,000. Now, you buy your first house for $300,000. The VA guarantees 25% of that loan, so you use up $75,000 of your entitlement. But look, you started with $175,000. You've only used $75,000. You still have $100,000 of entitlement left over. That is usable, ready-to-go entitlement that you can use to buy a second property. Following the same 25% rule, that remaining $100,000 in entitlement could allow you to buy another home for up to $400,000, again potentially with zero money down. This is how military families build real generational wealth. They use the VA loan to acquire properties at different duty stations, building a portfolio of real estate that generates passive income long after they've hung up the uniform. It's not a loophole. It's a feature of the program designed for the mobile military lifestyle. So this entitlement is your key. It's your purchasing power. It's your reusable ticket to homeownership. But how do you prove you have it? You can't just walk into a lender's office and say, "Trust me, I'm a veteran." You need proof. You need the one document that officially tells the lender that you have earned this benefit and how much of it you have available. This document is called the Certificate of Eligibility, or COE. Think of it as your VA loan passport. It's a simple one-page document, but without it, everything stops. It confirms to the lender that you meet the minimum service requirements to qualify for the loan. It shows your entitlement code, which tells them under what conditions you served. And most importantly, it shows the status of your entitlement, whether you have your full entitlement available, or if some of it is tied up in an existing property. Getting your COE is the absolute first non-negotiable step in the VA loan process. It's the green light. Before you look at houses, before you even talk seriously to a lender, you need to get your hands on your Certificate of Eligibility. It's the official confirmation of the promise the nation made to you. And while it sounds like just another piece of government paperwork, this single page is what separates you from the conventional homebuyer. It is the physical manifestation of your superpower. Now, the old way of getting your COE involved mailing in forms and waiting weeks for a response. But today, there are ways to get it almost instantly. And knowing how to do that, how to get that golden ticket in your hand within minutes, can shave weeks off your home buying journey and give you a massive advantage over other buyers. But there's a catch. The information on that COE isn't always straightforward. Understanding what it's truly telling you, especially if you've used the loan before, is a skill in itself. And that's exactly what we're going to break down next. The 3 fastest ways to get your COE, and how to read it like a pro so you know your exact purchasing power before you ever step foot in a lender's office. So, let's talk about getting that golden ticket, your certificate of eligibility or COE. This isn't just another piece of government paperwork. This is your official green light from the Department of Veterans Affairs. It's the document that makes a lender sit up and take you seriously. It's the proof that you've earned this benefit. Getting it should be your first operational objective. There are 3 primary ways to get it, and we're going to cover them from fastest to slowest, from the express lane to the scenic route. The first and, frankly, the best method for 99% of veterans is to let a VA-approved lender get it for you. I know it sounds counterintuitive. Why involve a lender before you even know if you're eligible? Here's why: they have a direct line. Experienced VA lenders have access to the VA's automated system, called the Web LGY system. For them, pulling your COE is often an instant 30-second process. They plug in your social security number and a few other details, and boom, the PDF is in their inbox. Costs you nothing, takes almost no time, and most importantly, it gets you a partner in the process from day one. Think of it this way. You wouldn't go on a mission in a foreign country without a local guide who speaks the language and knows the terrain. A good VA lender is your guide. They've done this 1,000 times. They know the pitfalls. Letting them pull your COE for you is the single fastest way to get your mission underway. Now, maybe you're the do-it-yourself type. You like to have all your ducks in a row before you talk to anyone. I respect that. In that case, your second option is the VA's eBenefits online portal. If you have an account set up, you can log in, navigate through the menus, and request your COE yourself. In a perfect world, if all your records are perfectly aligned in the VA system, this can also be pretty quick. The system might generate it for you right away and you can download it. But, and this is a big but, we're talking about a government website. Sometimes it's down for maintenance. Sometimes it glitches. Sometimes your records aren't perfectly synced, and it kicks back an error, telling you to submit a manual application anyway. So while it can work, it can also turn into a frustrating rabbit hole. It's a solid plan B, but I wouldn't make it your plan A. The third and final method is the old-school, analog way, mailing in a form. You'll need to find and fill out VA Form 26 to 1880, package it up with a copy of your proof of service, like your DD-214, and send it off to the VA's Regional Loan Center. This is, without a doubt, the slowest method. You're dealing with snail mail on both ends and manual processing in the middle. We're talking weeks, maybe even over a month, to get that piece of paper back in your hand. In a fast-moving housing market, that's an eternity. A house you love today will be sold twice over by the time your COE arrives. I only recommend this route as an absolute last resort, for complex cases or if you simply have no other choice. So let's recap the mission plan first. Call a VA-approved lender. That's your primary objective. If that doesn't work for some reason, your secondary is to try the eBenefits portal. Your contingency plan, your last resort, is the mail-in form. Okay, fast forward. You've executed the plan. You have the document. It's on your screen or printed in your hand. Now what? It looks intimidating. It's a dense block of text and codes. But understanding it is what separates the rookies from the pros. This is where you learn your actual power. Let's break it down box by box. At the top, you'll see your personal information: name, social security number, date of birth. The first thing you do, the very first thing, is check that it's all 100% correct. A single typo, a wrong digit in your social, can bring the entire home buying process to a screeching halt down the line. Verify your intel. Next, look for a box labeled Entitlement Code. This little 2-digit number is the VA telling the lender how you served. Code 10 means you're eligible based on National Guard or Reserve service. Code 05 is for post-Vietnam era veterans. Code 11 might mean you're an eligible surviving spouse. Each code corresponds to a specific period or type of service. This code is critical because it's the foundation of your eligibility. Now find the box for your funding fee. This is huge. This is where you can potentially save thousands and thousands of dollars. The box will say one of two things: exempt or non-exempt. If you receive VA disability compensation, you are exempt from the VA funding fee. If you see the word exempt in that box, I want you to understand what that means. On a $400,000 loan for a first-time homebuyer, the funding fee is 2.15%. That's $8,600. If you are exempt, that cost is completely waived. It vanishes. Seeing exempt on your COE is like finding a check for thousands of dollars you didn't know you had. If you are receiving VA disability and that box says non-exempt, You need to get on the phone with the VA immediately to get it corrected before you close on a loan. Okay, moving on. You'll see a section about previously used VA loans. For most of you, this will be blank or say none. But if you've used a VA loan before, it will list the details here. This is important for calculating your remaining entitlement, a concept we are going to dedicate an entire future part to, because it is the key to buying a second home or your dream home with the VA loan. For now, just know that this box tells the story of your VA loan history. Finally, we arrive at the most important and the most misunderstood number on the entire document, your basic entitlement. You will look at this box and you will see the number $36,000, and your heart will sink. You'll think, $36,000? I can't even buy a car for that, let alone a house. Relax. This is not your loan limit. Let me say that again. $36,000 is not the maximum amount you can borrow. This number is an old, outdated figure from the original GI Bill that has, for some reason, never been updated on the form. What this number actually represents is the amount the VA is guaranteeing to your lender on your behalf. The VA typically guarantees a quarter, or 25%, of the loan amount. So this $36,000 in basic entitlement is the VA's guarantee on a loan of up to $144,000. Now you're thinking, $144,000? That's still not enough to buy a house in most of the country. And you are absolutely right. This is where a second layer of protection called bonus entitlement, or Tier 2 entitlement, kicks in. This bonus entitlement bridges the gap between that $144,000 and the conforming loan limits in your area, which can be over $700,000, and in some high-cost areas, over $1 million. So when you look at that $36,000, don't see it as a limit. See it as a key. It's the base number that unlocks your full borrowing power. It's the VA telling your lender, we've got this veteran's back. We guarantee this amount. And that guarantee gives the lender the security they need to lend you hundreds of thousands of dollars, often with zero money down. So, when you put it all together, your verified personal info, your entitlement code confirming your service, your funding fee status saving you thousands, and your basic entitlement unlocking the door, this certificate of eligibility transforms from an intimidating government form into your personal statement of power. You are no longer just a veteran hoping to buy a house. You are an informed buyer, walking into a lender's office with a validated, government-backed certificate that says, I am ready. I am eligible. Here is my proof. But the COE is just one half of the equation. Proves you have the benefit, but it doesn't say how much a bank will actually lend you. That's determined by that full VA loan entitlement we just mentioned, and it's the key to unlocking those zero down payment jumbo loans you hear about. And cracking that code, well, that's what we're doing next. So let's crack it wide open. The concept of entitlement is probably the single most misunderstood part of the entire VA loan program. And the reason is simple. The word itself is confusing. When we hear entitlement, we think of a specific dollar amount like a gift card for a house. But that's not what it is. Think of your VA loan entitlement not as cash but as a promise. It's a guarantee slip that you, the veteran, hand to a private lender like a bank or a credit union. This slip is signed by the United States government and it says, Hey Bank of America, we trust this veteran. If you lend them money to buy a home and for some reason they can't pay it back and the loan goes into foreclosure, we, the VA, will cover 25% of your losses. That's it. That's the core of it. Entitlement is a 25% insurance policy for the lender, paid for by the VA. Why is this so powerful? Because it completely changes the bank's calculation of risk. A normal loan with zero down payment is incredibly risky for a bank. If the borrower defaults, the bank could lose a massive amount of money. But with the VA's 25% guarantee, a huge chunk of that risk is just gone. It vanishes. This is why lenders are willing to offer you, the veteran, a zero down payment loan with a fantastic interest rate and no private mortgage insurance. The VA's guarantee makes you the safest bet on their books. Now let's talk numbers. Your entitlement comes in two flavors: basic entitlement and bonus entitlement, which is also called Tier 2 entitlement. Everyone who is eligible for the VA loan starts with a basic entitlement of $36,000. Now stop. I know what you're thinking. $36,000? What can I even buy with that? Remember, that number is not your loan amount. It's the amount of the guarantee. And since the VA guarantees 25%, or 1/4 of the loan, you can do some simple math. If the VA is willing to guarantee $36,000, that covers 25% of a loan up to $144,000. For decades, this was effectively the ceiling. If you wanted a zero-down loan, you had to buy a house for around $144,000 or less. If the house cost more, you had to put down 25% of the difference. This system was tied to something called the conforming loan limit, a number set by the federal government that changes every year. For a long time, the VA loan limit was just a reflection of that federal limit. But then everything changed. On January 1, 2020, the Blue Water Navy Vietnam Veterans Act went into effect. Tucked inside this law was a monumental shift in the VA loan program. It essentially did one thing. It vaporized the VA loan limit for any veteran who has their full entitlement. Let me say that again because it is the most important sentence in this entire section. If you have your full VA loan entitlement, there is no longer a VA loan limit. Zero. None. You can buy a $900,000 house, a $1.5 million house, a $3 million house. If a lender looks at your income, your credit, and your debt and says, yes, we will lend you $2 million, then you can buy a $2 million house with $0 down. Your limit is no longer what the VA says. Your limit is what the bank says you can afford. This is the superpower of the modern VA loan. So the obvious next question is, who has full entitlement? You have your full entitlement if you meet one of these conditions. You've never used your VA loan benefit before, or you've used it but you paid off the loan in full and sold the property, or you've used it, paid off the loan, and another eligible veteran formally assumed your loan when you sold the property. In any of those cases, your entitlement is fully restored, it's a clean slate, and you have access to that unlimited, no down payment purchasing power. But what if that's not you? What if you already have a VA loan on a house, and you're not selling it? Maybe you're moving because of a PCS, a permanent change of station, and you want to keep your first home and rent it out. This is an incredibly common scenario for active duty service members, and it's a brilliant way to build wealth. In this case, you don't have your full entitlement available because some of it is tied up in that first property. This is where bonus or Tier 2 entitlement becomes your best friend. This is where the math comes in, but I promise to make it simple. Let's use an example. Let's talk about Staff Sergeant Rodriguez. A few years ago, she got stationed in Texas and bought a home for $250,000 using her VA loan. The VA guaranteed 25% of that loan for her lender. So, 25% of $250,000 is $62,500. That means $62,500 of her entitlement is currently tied up in her Texas home. Now Sergeant Rodriguez has new orders. She's moving to the high-cost area of San Diego, California, and she wants to buy a new home there. She's keeping the Texas house as a rental property. She doesn't have her full entitlement, but she has a lot of it left. So, how much can she borrow with zero down payment for her new house in San Diego? This is the one time that old conforming loan limit still matters. Let's say for this year, the conforming loan limit in San Diego County is $1,089,300. The VA guarantees loans up to 25% of this county limit. So the VA's maximum possible guarantee in San Diego is 25% of $1,089,300, which is $272,325. That's the total amount of entitlement available in that county. Now we just subtract what Sergeant Rodriguez has already used. Her total available entitlement is $272,325, and she has $62,500 tied up in her Texas home. So, her remaining entitlement is $272,325 minus $62,500, which equals $209,825. That's her available bonus entitlement. So, what's her new zero down payment limit? We just reversed the math. Since that remaining entitlement represents 25% of a loan, we multiply it by 4. $209,825 times 4 is $839,300. That is Sergeant Rodriguez's maximum zero down payment loan amount for her new home in San Diego. She can walk into a real estate office and confidently make a zero down offer on any house up to that price, all while keeping her first home as an investment. This is an absolutely life-changing financial advantage that simply does not exist in the civilian world. But what if she finds her dream home, and it costs $900,000? Is she out of luck? Not at all. This is another myth. You can absolutely buy a home for more than your remaining entitlement calculation. You just have to make a small down payment, and the VA makes that calculation incredibly fair. The rule is this: You have to pay 25% of the difference between the purchase price and your maximum zero down loan amount. So the house price is $900,000. Her max zero down loan is $839,300. The difference is $60,700. Sergeant Rodriguez needs to put down 25% of that difference. 1/4 of $60,700 is $15,175. Think about that. To buy a $900,000 home, her down payment is just over $15,000. That is a down payment of just 1.6%. A conventional borrower would likely need to come up with 5%, 10%, or even 20%. That's anywhere from $45,000 to $180,000 out of pocket. She gets to do it for a tiny fraction of that, and she still won't have to pay any monthly private mortgage insurance. So let's zoom out. You have two paths. If you have your full entitlement, your purchasing power is effectively limitless. Your only ceiling is your personal financial qualification. If you have partial entitlement because you're already using this amazing benefit, you have a very generous cap for a zero down loan and an incredibly affordable path to buying homes even above that cap. Understanding your entitlement is like being handed the keys to the kingdom. It dictates your strategy, your budget, and your ability to build a real estate portfolio. But knowing the theory is one thing, proving it is another. To a lender, you can't just say, "I have full entitlement." You need to show them the official document from the Department of Veterans Affairs that proves your eligibility and spells out exactly how much entitlement you have available. That document is called the Certificate of Eligibility, the COE. And getting your hands on that COE, understanding every single box on that form, and making sure it's accurate, that's our mission for the next part. Think of the Certificate of Eligibility, or COE, as your golden ticket. It's the official, non-negotiable document from the Department of Veterans Affairs that tells a lender one simple, powerful thing. Yes, this person has earned the VA home loan benefit. Without it, you're just talking. With it, you're in the game. This isn't just a piece of paper. It's the VA's signed promise to you, a testament to your service. So let's get it. There are three primary ways to secure this critical document. The first, and by far the most common and efficient, is to let your lender do it for you. This is the easy button. A good VA-savvy lender has direct access to a system called the VA's Web LGY, which stands for Loan Guarantee. It's their digital hotline to the VA. In most cases, a lender can log into this system, enter your information, like your social security number and date of birth, and get an instant automated COE back in a matter of seconds. It's that fast. This is the path of least resistance, and for the vast majority of veterans, especially those who served on active duty and have a straightforward service history, it's the way to go. You're already going to be working with a lender to get pre-approved, so you might as well let them handle this piece of the puzzle. They do it every single day. They know what they're looking for and can get it done while you're on the phone with them. But what if you want to get it yourself? Maybe you're not ready to talk to a lender yet. Maybe you just want to have all your ducks in a row before you even start the house hunt. That's smart. This is the second path, going directly to the VA yourself. Think of this as the do-it-yourself route. You have two main options here. The fastest is online, through the VA's e-benefits portal. If you have an account set up, you can log in, navigate to the housing section, and request your COE electronically. The system will guide you through the steps, and again, if your records are clear in the VA system, you might get it back almost instantly or within a few hours. The other DIY option is the old-school, tried-and-true method, mail. You'll need to fill out VA Form 26 to 1880, which is the request for a certificate of eligibility. You'll download it, fill it out, and mail it in with your proof of service to the VA Regional Loan Center that handles your state. Now, this is obviously the slowest route. You're dealing with snail mail and government processing time, so expect to wait several weeks. It's reliable, but it's not for anyone in a hurry. Now, for either of these DIY methods, you're going to need to provide proof of service. This is the critical piece of intel the VA needs to verify your eligibility. What that proof is depends on your service history. For most veterans, the Holy Grail document is the DD Form 214, the Certificate of Release or Discharge from Active Duty. If you were discharged after 1950, you need to provide member copy 4. It's the most comprehensive version. If you are still on active duty, you'll need a statement of service signed by your commander or personnel officer. This statement needs to show your full name, social security number, date of birth, the date you entered duty, the duration of any lost time, and the name of the command providing the information. For Guard and Reserve members, it's a bit different. you'll need a copy of your latest annual retirement points summary, along with evidence of your honorable service. This documentation is key because it proves you've met that 6-year service requirement we talked about earlier. This brings us to the third path for getting your COE, which I call the special operations route. This is for more unique circumstances, like for a surviving spouse. If you are the unremarried spouse of a veteran who died in service or from a service-connected disability, or the spouse of a service member missing in action or a prisoner of war, you are also eligible for the VA loan benefit. To get your COE, you'll need to fill out a different form, VA Form 26 to 1817, the request for determination of loan guarantee eligibility, unmarried surviving spouses. You'll also need to provide the veteran's 214 and copies of both your marriage license and the veteran's death certificate. It's more paperwork, but it's the pathway to securing a benefit that was earned by your loved one's ultimate sacrifice. So, to recap the mission, Path 1, let your lender pull it instantly. Path 2, go get it yourself online or by mail. Path 3, for special circumstances like surviving spouses. Whichever path you choose, the end result is the same. You get that certificate of eligibility in your hands. But getting the COE is only half the battle. The other half is understanding what it actually says. This document is packed with codes and numbers that mean everything to a lender. Let's decode it box by box. When you look at your COE, you'll see several key fields. The first one to pay attention to is your entitlement code. This is a 2-digit code that tells the lender why you are eligible. For example, code 05 means you served during the post-Vietnam era. Code 10 means you're eligible based on your service in the selected reserve. Code 08 is for a surviving spouse. This code is the first thing a lender checks. If it's correct, they move on. Next, you'll see a box for basic entitlement. This is probably the most misunderstood part of the entire VA loan. In this box, you will almost always see the number $36,000. Let me say that again, $36,000. And right now, you might be thinking, $36,000? I can't even buy a garage for that. And you are absolutely right. This number is not, I repeat, not your maximum loan amount. It is an old, almost vestigial figure that represents the amount of basic entitlement the VA guarantees for you. For now, just know that this $36,000 is the key that unlocks a much, much larger number. It's the seed from which your true buying power grows. And we will dedicate a whole future part to how that calculation works. For now, just see that number and know it's normal. Right below or next to the entitlement section, you'll find a crucial piece of information about your funding fee. The box will either say exempt or non-exempt. If it says exempt, congratulations. This means you do not have to pay the VA funding fee. This exemption is typically granted to veterans receiving VA disability compensation or surviving spouses of veterans who died in service or from a service-connected disability. This can save you thousands, even tens of thousands of dollars at the closing table. It is a massive financial advantage. If it says non-exempt, it simply means you will have to pay the standard funding fee, which can be financed into the loan. It's critical that this box is correct. If you are receiving VA disability benefits and your COE says non-exempt, you need to get that fixed immediately by providing the VA with your disability award letter. Finally, and this is incredibly important, there's a section for prior loans charged to entitlement. This section is a history log. It will list any previous VA loans you've taken out. It will show the loan number, the property address, and whether the loan is still active or has been paid in full. If you've never used your VA loan before, this section will be blank. But if you have, this is where the VA tracks how much of your entitlement is currently tied up in another property. This is the official record that determines if you have enough entitlement left over to buy another home. It's the foundation for understanding how you can use your VA loan benefit over and over again. So you have your COE. You understand the entitlement code, you've seen the mysterious $36,000 of basic entitlement, you know your funding fee status, and you've checked your prior loan history. You're holding the key. But this key, this basic entitlement, only unlocks the first door. What about buying a home for $500,000, $700,000, or even $1 million with zero down payment? How is that possible when your COE only says $36,000? The answer isn't on this piece of paper. It lies in a second, invisible layer of your benefit, something called bonus entitlement or Tier 2 entitlement. This is where the real power of the VA loan is unleashed. Your COE is your starting point, not your limit. In the next part, we're going to go beyond the paper. We're going to do the math and unlock your true full buying power. So let's do it. Let's turn that piece of paper, your certificate of eligibility, into real-world purchasing power. This is where the theory ends and your new life begins. To understand the math, you have to understand the promise. The VA loan isn't a loan from the government. It's a promise, a guarantee, that the Department of Veterans Affairs makes to a private lender on your behalf. That promise is that if you, the veteran, are unable to pay your mortgage, the VA will step in and cover a portion of the lender's loss. Specifically, the VA guarantees 25% of the loan amount. Think of it like a safety net. For the lender, loaning money to you with no down payment is a huge risk. But with the VA's 25% guarantee, that risk is massively reduced. It gives them the confidence to say yes when other loan programs would say no. This 25% figure is the golden key to unlocking everything. Every calculation we're about to do comes back to this number. Let's start with the simplest and most powerful scenario. You have your full 100% VA loan entitlement. This means you've never used your VA loan before, or you used it, paid it off, sold the house, and had your entitlement fully restored. Your COE shows a basic entitlement of $36,000. Now, your first reaction might be, $36,000? What can I possibly buy with that? And you're right to ask. But remember, that's not the loan amount. That's the amount the VA is willing to guarantee. So if the VA guarantees 25% of the loan, and their basic guarantee is $36,000, lenders have traditionally used a simple formula. They will lend you 4 times your entitlement. Let's do that math. $36,000 times 4 equals $144,000. And right now I can hear you shouting at the screen, $144,000. That buys a garage in my city. And for a long time that was a major limitation. But here's where everything changed. Thanks to the Blue Water Navy Vietnam Veterans Act of 2019, a monumental shift occurred. For veterans with their full Tier 1 entitlement, the VA loan limits were effectively eliminated. Let me say that again because it is the single most important update to this benefit in decades. If you have your full entitlement, there is no longer a cap on how much the VA will guarantee for your loan. So what does that mean for your buying power? It means your zero down payment buying power is now limited only by what the lender determines you can afford based on your income, your credit, and your debt. The old calculation of $36,000 times 4 is gone. It's irrelevant. The new reality is this. If a lender qualifies you for a $500,000 loan, you can get it with $0 down. If they qualify you for a $900,000 loan, you can get it with $0 down. If you're a high-income earner and they qualify you for a $1.5 million loan, you can buy that home with $0 down. This is the superpower of having your full entitlement. The cap is gone. Your purchasing power is dictated by your financial profile, not by an arbitrary government limit. But what if you don't have your full entitlement? What if you're one of the thousands of veterans who already have a VA loan? Maybe you bought a small starter home at your first duty station, and now years later you have a family you've PCS'd across the country and you need a bigger place. You haven't sold that first home. Maybe you're renting it out, building equity. You might think your benefit is tapped out, that you have to save up for a conventional loan. This is where most people get it wrong, and it's where Tier 2 entitlement becomes your secret weapon. Let's create a real-world scenario. We'll call him Sergeant Miller. 5 years ago, Sergeant Miller bought a condo for $240,000 near his base in Virginia. To do that, the VA guaranteed 25% of that loan. So, 25% of $240,000 is $60,000. That is the amount of his entitlement that is currently tied up, or in use, on that Virginia condo. Now, Sergeant Miller has orders to move to Texas. He and his family want to buy a house there for around $500,000. He looks at his COE and sees his basic entitlement of $36,000 is used up, and then some. He feels stuck. But he's not. Here's how we calculate his true buying power using Tier 2. First, we need to know the conforming loan limit for the county he's moving to in Texas. These limits are set by the Federal Housing Finance Agency each year. For most of the country in 2023, that limit is $726,200. We'll use that number. The VA guarantees 25% of a loan up to this county limit. So, the maximum potential guarantee the VA offers in that Texas county is 25% of $726,200, which equals $181,550. This is the total amount of guarantee power available to Sergeant Miller. Now we simply subtract the entitlement he's already using on his Virginia condo. So, we take the total available guarantee of $181,550 and subtract the $60,000 he has tied up. That leaves him with $121,550. This is his remaining entitlement. This is his Tier 2 power. So, what can he buy with zero down payment? We go back to that magic formula. The lender will lend him 4 times his available entitlement. So, we multiply his remaining entitlement of $121,550 by 4. The result is $486,200. This is a life-changing number. Sergeant Miller, who thought his benefit was completely used up, can now walk into a lender's office and get pre-approved to buy a home worth up to $486,200 with absolutely zero money down. He gets to keep his first property as an investment and still buy a second home for his family. This is the power of Tier 2. It allows you to own multiple properties at once using your VA benefit. But what if the perfect house for his family costs a little more? Let's say they find a dream home listed for $520,000. Is the deal dead? Absolutely not. He just needs to come up with a small down payment. And here's another place where the math is incredibly favorable to the veteran. You might think he has to pay the full difference between the price of the house, $520,000, and his max zero down loan, $486,200. That would be over $33,000. But that's not how it works. With a VA loan, when you exceed your entitlement limit, you only have to put down 25% of the difference. Let's run the numbers. The house is $520,000. His max zero down loan is $486,200. The difference between those two numbers is $33,800. He is only required to bring 25% of that difference to the closing table. 1/4 of $33,800 is $8,450. Think about that. To buy a $520,000 home, Sergeant Miller needs a down payment of less than $9,000. For a conventional loan, he'd be looking at a minimum of $26,000, and more likely over $50,000 to avoid private mortgage insurance. With an FHA loan, it would be over $18,000. The VA loan saves him tens of thousands of dollars out of pocket, even when he has another VA loan active. This is not a loophole. This is the benefit working exactly as it was designed, to give you the veteran maximum flexibility and buying power in any housing market. Whether you have full entitlement and can buy $1 million home with no money down, or you're using your Tier 2 entitlement to build a real estate portfolio, the math is designed to work in your favor. You now understand the engine of the VA loan. You know how the 25% guarantee translates into real dollars and cents. You know how to calculate your zero down buying power, and you know how to calculate the small down payment needed if you choose to dream even bigger. But there's one more critical piece of the financial puzzle we have to talk about. It's a cost unique to the VA loan, and it's a term that often causes confusion and anxiety. The VA funding fee. What is it? Why does it exist? And most importantly, how much is it going to cost you? The good news is, for many of you, the answer is nothing at all. And for everyone else, it's not the scary monster you think it is. In the next part, we're going to demystify the VA funding fee once and for all. The VA funding fee. It sounds ominous, doesn't it? Like some secret password you have to pay just to get in the door. It's the one part of the VA loan process that causes the most confusion and, frankly, the most anxiety. People see the word fee and immediately think of hidden costs, of someone trying to pull a fast one. And when they see it can be thousands of dollars, the panic can really set in. So let's pull back the curtain on this thing. Let's stare it right in the eye, because once you understand it, you'll see it's not the villain of this story. In fact, it's the very thing that makes this entire incredible benefit possible. First, what is it? The VA funding fee is a one-time fee paid to the Department of Veterans Affairs. But here's the crucial part. It's not profit. The VA isn't running a business here. This fee goes directly into a fund that ensures the loans for all veterans. Think of it like this. The VA loan program is a self-sustaining ecosystem. The fee paid by veterans today helps the VA guarantee the loans for the veterans of tomorrow. It's the pay-it-forward mechanism that keeps the whole system running. Without it, the VA couldn't offer that 100% guarantee to lenders. And without that guarantee, lenders would never, ever offer zero down payment loans with fantastic interest rates. So that fee, it's the fuel for the engine that powers your homeownership dream. It's what makes the magic happen. Okay, so it has a noble purpose. But the big question remains. How much is it going to cost me? This is where the details matter, and it's not a one-size-fits-all answer. The percentage you pay depends on 3 main factors. 1. What type of service you had. 2. Whether it's your first time using the VA loan benefit. And 3. How much of a down payment you're making, if any. Let's break it down. For most active duty, veterans, and separated service members using the benefit for the very first time with 0 down payment, the fee is 2.15% of the loan amount. So, on a $400,000 loan, that's $8,600. Now, if you've used your VA loan benefit before, say you bought a house a decade ago, sold it, and are now buying a new one, this is called a subsequent use. For subsequent use with 0 down payment, the fee is a bit higher, typically 3.3%. Why the increase? Because the risk is considered slightly higher on a second-time use, and the fee adjusts accordingly. Now, for our brothers and sisters in the National Guard and Reserves, the numbers are slightly different. For a first-time use with no money down, the fee is 2.4%. Again, this is simply based on the VA's long-term actuarial data. It's not a penalty. It's just a different calculation based on the structure of service. But here is where you, the borrower, get to take control. This isn't a fixed, non-negotiable number. You can actively lower your funding fee by making a down payment. And you don't need to put down 20%. Even a little bit makes a big difference. If you put down at least 5% but less than 10%, that first-time use fee of 2.15% drops all the way down to 1.5%. Let's run the numbers on that same $400,000 house. A 5% down payment is $20,000. Your new loan amount is $380,000. The funding fee at 1.5% of that is $5,700. By putting money down, you just saved yourself nearly $3,000 on the fee. If you can manage a down payment of 10% or more, the fee drops even further to just 1.25%. This gives you the power to choose what works best for your financial situation. The 0 down option is there, and it's amazing. But if you have some savings, you can use it strategically to reduce your costs. Okay, that's a lot of percentages. But what if I told you that for a huge number of veterans, this entire conversation is basically irrelevant? What if I told you that for many of you, the funding fee is 0? Just disappears. That's right. You can be completely exempt from paying the VA funding fee. This is one of the most powerful and often overlooked aspects of the entire program. The VA waives the fee for several categories of veterans and surviving spouses. The most common exemption is for veterans who are receiving VA compensation for a service-connected disability. If you have a disability rating from the VA, you are exempt. Period. It doesn't matter if your rating is 10% or 100%. If you are receiving that compensation, you do not pay the funding fee. This also applies to veterans who would be receiving compensation, but are receiving retirement or active duty pay instead. Another major group who are exempt are eligible surviving spouses of veterans who died in service or from a service-connected disability. And as of recent changes, active duty service members who have been awarded the Purple Heart are also exempt from the funding fee. This is a massive, massive benefit. On that same $400,000 loan, that's an instant savings of over $8,000. How do you know for sure if you're exempt? It's simple. When you get your certificate of eligibility, or COE, which we talked about in an earlier part, it will state it right there on the form. It will say funding fee exempt in plain English. Your lender will see this, and the fee will never even be part of your loan calculation. So let's say you've done the math. You're not exempt and you know what your fee will be. Let's go back to that $8,600 figure for a first-time user. Now comes the next wave of panic. Where am I supposed to get an extra $8,000 for closing? Take a deep breath. You almost certainly don't have to. This is the final and most important piece of the funding fee puzzle. You have 2 ways to pay it, and 99% of veterans choose the second option. Option 1 is to pay it in cash at closing, just like you would your down payment or other closing costs. If you have the cash and want to do this, you absolutely can. But almost nobody does. Option 2 is the game changer. You can finance it. You can roll the entire funding fee into your total loan amount. Let's be crystal clear about what this means. On that $400,000 loan with an $8,600 funding fee, your new total loan amount simply becomes $408,600. You don't write a check for it. You don't bring a briefcase of cash to the title company. It just gets absorbed into the mortgage, and you pay it off over the next 30 years as a small part of your monthly payment. And how small are we talking? Well, let's do some quick math. That extra $8,600, spread out over a 360-month mortgage at a 6.5% interest rate, adds about $54 to your monthly payment. $54. That's probably less than your monthly subscription to streaming services. Suddenly, that scary 5-figure monster of a fee has been transformed into a completely manageable, almost unnoticeable part of your budget. It's the difference between a pizza night and not a pizza night. So let's recap this beast. The VA funding fee is not a junk fee. It's the lifeblood of the program. The amount you pay depends on your service, prior use, and down payment, but you can actively lower it. A huge number of veterans with service-connected disabilities and Purple Heart recipients pay nothing at all. And for everyone else, you can simply roll it into the loan, turning a daunting upfront cost into a tiny addition to your monthly payment. The mystery is gone. The fear is gone. You now understand the VA funding fee better than 95% of the population. So we've conquered the money monster. The funding fee is no longer a mystery. You know what it is, why it exists, and how to handle it. But getting the money is only half the battle. The house itself has to pass a test. It has to meet the VA's standards for safety, security, and sanitation. This isn't just red tape. It's a layer of protection built specifically for you, the veteran. And in the next part, we're going to break down exactly what the VA is looking for in a home, the minimum property requirements, so you can house hunt like a pro and avoid any nasty surprises during the appraisal. So, what exactly are these minimum property requirements, or MPRs, that the VA is so focused on? Think of them less as a bureaucratic checklist and more as a pre-deployment inspection for your future home. The VA's primary mission here is to protect you, the veteran. They want to ensure that the home you're buying with your hard-earned benefit is a solid, safe, and sound investment, not a money pit disguised with a fresh coat of paint. They're essentially your most experienced squad leader, doing a final walkthrough to make sure you're not walking into an ambush of hidden costs and dangerous defects. The entire philosophy behind MPRs can be boiled down to 3 simple words: safe, sound, and sanitary. Every single requirement falls under one of these 3 banners. Let's break them down, because knowing this stuff is what separates a savvy homebuyer from someone who gets hit with a last-minute, deal-killing surprise. First up, safe. This is the big one. The VA wants to know that you and your family can live in the home without any immediate risk to your health or well-being. This covers the systems that make a house function. We're talking about the electrical system. Are there frayed wires hanging out of the walls? Is the electrical panel an ancient fire hazard from the 1950s? The VA appraiser is going to look for that. They want to see a system that can handle the load of modern life, your computers, your big screen TV, your air fryer, without blowing a fuse or worse, starting a fire. Safety also includes the plumbing. The system needs to be free of major leaks. A slow drip under the sink might be a simple fix, but a major leak in a wall can lead to catastrophic mold and rot. The VA is looking for a functional system that delivers clean, potable water. You need a reliable source of hot water too. A functioning water heater isn't a luxury. It's a requirement. And of course, safety means structural integrity. The house needs to be stable. A few hairline cracks in the drywall might be normal settling, but giant, sprawling cracks in the foundation or bowing basement walls are massive red flags. The VA wants to ensure the home isn't on the verge of collapsing. This also extends to things like handrails on staircases. If you have a set of 4 or more stairs, there needs to be a handrail. It seems small, but it's a simple safety measure that prevents falls and injuries. The second pillar is sound. This refers to the physical condition of the property itself, the bones of the house. The VA wants to make sure the home is structurally sound and will protect you from the elements. The most obvious component here is the roof. The appraiser will assess the roof's condition. It doesn't have to be brand new, but it must have a reasonable amount of life left in it. Typically, the VA wants to see at least a few years. It can't be actively leaking or have gaping holes and missing shingles. A bad roof is one of the quickest ways to destroy a home from the inside out, and the VA knows it. The foundation, as we mentioned, is critical. It must be sound and stable. The appraiser will also look at the exterior walls to make sure there's no severe deterioration. They're checking that the home is built to withstand the typical weather of its location. A huge part of the sound requirement, and one that trips up a lot of buyers looking at older homes, is lead-based paint. For any home built before 1978, the VA appraiser is required to check for chipping, peeling, or flaking paint. If they see it, it must be addressed. It doesn't mean the whole house needs to be stripped down. The seller just needs to scrape the defective paint and repaint those specific areas. This is a federal health and safety issue, especially for families with young children, and the VA takes it very seriously. Finally, we have the third pillar, sanitary. This is about the home providing a clean and healthy living environment. The most basic requirement here is a supply of safe drinking water and a functioning sanitary disposal system. Whether the house is on city water and sewer or a private well and septic tank, both systems must be in good working order. If there's a private well, the appraiser may require a water quality test to ensure it's safe for consumption. If there's a septic system, it has to be functional and properly located, not too close to the well or property lines. The sanitary requirement also means the home must be free from any major pest infestations. We're talking about the nasty stuff: termites, wood-boring beetles, or severe rot. In many parts of the country, especially in the South and West, a separate termite or pest inspection is required for a VA loan. The appraiser will note if one is needed. If an inspection finds evidence of active termites, it has to be treated, and any damage they caused has to be repaired before the loan can close. The VA is making sure you're not sharing your mortgage with an army of wood-destroying insects. Beyond these big three, there are a few other key NPRs to be aware of. The property must have adequate access. This means you need to be able to get to your house year-round from a public or private street. You can't buy a beautiful cabin in the woods if the only way to get there in the winter is by snowmobile. The home also needs a permanent heat source that can keep the living areas at a comfortable temperature. In a place like Minnesota, this is obviously non-negotiable. In a place like Florida, it's still a requirement. Note that the VA doesn't universally require air conditioning, but if the appraiser determines that central air is standard for the area and essential for the home's marketability, they might flag a broken SC unit as something that needs to be repaired. The property also has to be a residential dwelling. You can't use a VA loan to buy a downtown office building or a storefront, unless it has a residential unit attached and meets specific zoning and use requirements. So, how does all this play out in the real world? When you go under contract on a home, your lender will order a VA appraisal. The VA-approved appraiser has two jobs. First, to determine the fair market value of the home, and second, to act as the VA's eyes and ears, ensuring the property meets all these minimum property requirements. They will walk through the entire property, inside and out, with the NPR checklist in mind. Now, here's the most important part, the part that causes the most anxiety. What happens if the appraiser finds a problem? What if they see peeling paint or a leaky faucet or a broken window? First, don't panic. This is incredibly common, especially with older homes. It is not an automatic deal killer. When the appraiser finds an NPR issue, they will note it on the appraisal report, which is called a notice of value. The appraisal will be marked subject to the completion of specific repairs. This means the loan cannot close until those issues are fixed and re-inspected. You now have a few options. The most common path is that the seller agrees to make the required repairs. In most markets, this is the standard expectation. Your real estate agent will negotiate with the seller's agent to have them hire a contractor and fix the items on the appraiser's list. Once the work is done, the appraiser comes back out for a final inspection to verify the repairs, signs off, and the loan process moves forward. What if the seller refuses? This is less common, but it happens. You could potentially negotiate a lower price to compensate for the cost of repairs you'll have to do after closing, but the NPR-related repairs must be done before closing. So you can't just accept the house as is. In very rare cases, a lender might allow you to fund an escrow account at closing to pay for the repairs, but that's complex and not guaranteed. Your final option is to walk away. And while that's disappointing, remember the purpose of the NPRs. They did their job. They protected you from buying a home with potentially serious and expensive problems. It's better to find out about a faulty roof during the appraisal than during the first major rainstorm after you've moved in. The NPRs are your safety net, ensuring your VA loan gets you into a home that's not just a place to live, but a solid foundation for your future. So now you know how to find a home that meets the VA standards for safety and quality. But what about the costs that come after you get your offer accepted? There's one specific fee that every veteran needs to know about: the VA funding fee. Some veterans don't have to pay it at all. In the next part, we'll break down exactly what it is, who pays it, and how you might be exempt, potentially saving you thousands of dollars right at the closing table. So what exactly is this VA funding fee? Think of it as the insurance that makes the whole VA loan program possible. Since the government is guaranteeing a portion of your loan, which allows lenders to offer incredible terms like zero down payment and no monthly mortgage insurance, They need a way to offset the risk and cost to taxpayers. The funding fee is a one-time payment that helps cover any losses from loans that might go into default. It's the mechanism that keeps this benefit self-sustaining for future generations of veterans. Now, this isn't a one-size-fits-all fee. The amount you'll pay is a percentage of the total loan amount, and that percentage is determined by three main things: your service type, meaning regular military versus reserves or National Guard, whether it's your first time using the VA loan benefit, and how much of a down payment you're making, if any. Let's break down the most common scenario. A veteran purchasing a home. For your very first VA home loan, if you're putting zero money down, the funding fee is currently 2.15% of the loan amount for regular military, veterans, and active duty members. If you're in the National Guard or reserves, it's slightly higher at 2.4%. So, on a $400,000 loan, a first-time active duty user would have a funding fee of $8,600. But here's where you can strategically lower that fee. If you decide to make a down payment, the VA rewards you. If you put down at least 5% but less than 10%, that 2.15% fee drops to 1.5% for regular military. Put down 10% or more, and it drops even further to 1.25%. The same principle applies to Guard and Reserve members, with their rates also decreasing with a larger down payment. This is a powerful incentive. Making even a small down payment can save you thousands of dollars on this one fee alone. Now, what if this isn't your first rodeo? What if you're using your VA loan benefit for a second, third, or fourth time? This is called subsequent use, and the fee is higher. For a subsequent use loan with zero down payment, the funding fee jumps to 3.3% for all categories of service members, whether you're regular military, Guard, or Reserve. Again, making a down payment will reduce this percentage. A 5% down payment lowers it to 1.5%, and a 10% down payment brings it down to 1.25%, the same reduced rates as a first-time user. The VA heavily incentivizes putting some skin in the game if you can, especially on subsequent uses. The funding fee also applies to refinancing. For a VA cash-out refinance, the fee structure is similar to a purchase loan. For a first-time use, it's 2.15% for regular military and 2.4% for Guard and Reserves. For subsequent use, it's 3.3% for everyone. However, there's another type of refinance called an interest rate reduction refinance loan, or IRRL, which is often called a VA streamline. This loan has a much simpler and lower funding fee. For every single veteran, regardless of first-time or subsequent use, the funding fee for an IRRL is a flat 0.5%. That's it. It's incredibly low, which is part of what makes the VA Streamline such a popular and powerful option for veterans looking to lower their interest rate. So, you know the percentages, you've calculated the fee. How do you actually pay it? You have two choices. The first is to pay it in cash at closing. You simply bring a check for the full amount along with your other closing costs. The benefit here is that you're not paying interest on the fee for the next 30 years. The downside, of course, is that it requires a significant amount of cash up front, which many homebuyers don't have. That's why the second, and by far the most common option, is to roll the funding fee into your total loan amount. Let's go back to that $400,000 loan with an $8,600 funding fee. Instead of paying that $8,600 out of pocket, your final loan amount would become $408,600. Your monthly payment will be slightly higher because you're borrowing more, but it allows you to close on the home with much less cash. For most veterans, this is the most practical path forward. But here's the part that can literally change the financial picture of your home purchase. The part we've all been waiting for: the exemptions. This is where you could save those thousands or even tens of thousands of dollars we just calculated. Some veterans are completely exempt from paying the VA funding fee. This is not a discount, it's a complete waiver. The fee is zero. So who gets this incredible benefit? The VA has a very specific list of individuals who are exempt. First, and most common, is a veteran who is receiving VA compensation for a service-connected disability. If you have a disability rating from the VA, and you are receiving monthly payments for it, you do not have to pay the funding fee. It doesn't matter if your rating is 10% or 100%. If you are receiving compensation, you are exempt. Second is a veteran who would be entitled to receive compensation for a service-connected disability, but is receiving retirement pay or active duty pay instead. This is a crucial distinction. Some veterans, particularly those with long careers, might choose to receive their retirement pay instead of VA disability pay because it's the higher amount. The VA recognizes this and says as long as you are entitled to that disability compensation, you are still exempt from the funding fee, even if you're not actively receiving the check. Third on the list are surviving spouses of veterans who died in service or from a service-connected disability. If you are receiving dependency and indemnity compensation, or DIC, you are also exempt from paying the funding fee. This is a critical benefit for Gold Star families. And finally, a newer exemption. An active duty service member who provides evidence that they have been awarded the Purple Heart is also exempt. The award must have been made prior to the loan closing date. How do you make sure you get this exemption if you qualify? It all starts with your Certificate of Eligibility, or COE. In most cases, if you are exempt, your COE will state it directly. It will have a code or a line that says, funding fee exempt. When your lender pulls your COE and sees that, they know not to charge you the fee. It's that simple. But what if you know you're exempt, but your COE doesn't show it? This can happen, especially if your disability rating is recent. Don't panic. This is where you need to be proactive. You will need to provide your lender with other documentation. The most important document is your VA award letter, the official letter that details your disability rating and your compensation amount. Your lender can use this to get your COE updated and ensure the exemption is applied to your loan. And here's a pro tip that many people miss. What if you close on your home and then get your disability rating? Let's say you have a claim pending with the VA. You close on your house in May and have to pay the funding fee. Then in August, the VA grants your claim and makes your disability rating retroactive to a date before your closing. In this situation, you are entitled to a full refund of the VA funding fee you paid. You would need to contact the VA with your closing documents and your new award letter, and they will process a refund directly to you. This is life-changing money that many veterans don't realize they can get back. Understanding the funding fee, and especially the exemptions, is one of the most powerful pieces of knowledge you can have in this process. It separates the informed buyer from the one who might leave money on the table. It's not just a minor detail. It's a core component of the VA loan that directly impacts your wallet. But knowing the fees is just one part of the puzzle. The final step is bringing it all together and navigating the actual application process from start to finish, which is exactly where we're headed next. Alright, this is it. The final phase of the operation. You've learned the what, the why, and the how much. You understand the incredible power of this benefit, from zero down payment to no private mortgage insurance. You know about the funding fee, the entitlement, and the crucial differences that set the VA loan apart from every other mortgage on the planet. Now it's time to execute. This is your step-by-step field manual for going from thinking about buying a home to holding the keys in your hand. First, you need your orders. In the world of VA loans, this is your Certificate of Eligibility, or COE. This is the one document that proves to the lender that you have, in fact, earned this benefit through your service. Without it, the process is a non-starter. Think of it as the official proof that you qualify for the mission. Now, getting your COE sounds intimidating, but it's actually the easiest part. The absolute best way to get it is to let your VA-approved lender do it for you. They have a direct line to the VA system and can often pull it for you in a matter of minutes. You can also apply for it online through the VA's benefits portal, or even by mail, but letting your lender handle it is the most efficient route. It's their first task, and it immediately tells you if they know what they're doing. Once your eligibility is confirmed, it's time to assemble your fire team. This starts with getting a rock-solid pre-approval from a lender. And I can't stress this enough. You need to work with a lender who is a true expert in VA loans. Not someone who does one or two a year, but someone who lives and breathes this stuff. A general mortgage broker might see the VA loan as complicated or slow, but a specialist knows it's the best loan product on the market. Ask them directly, how many VA loans did you close last year? If they hesitate or give a low number, thank them for their time and move on. A great VA lender will be your most valuable team member. They'll help you get that COE, run your numbers, and give you a pre-approval letter. Now, a pre-approval is not a pre-qualification. A pre-qualification is a quick guess based on what you tell the lender. A pre-approval is a deep dive. The lender will verify your income, pull your credit, and analyze your debt. The result is a letter that says, "We are prepared to lend this veteran X amount of money." This letter is your golden ticket. When you go house hunting, this letter transforms you from a window shopper into a power buyer. It tells sellers and their agents that you are serious, you are qualified, and you are ready to close the deal. In a competitive market, a strong pre-approval can be the deciding factor that gets your offer accepted. With your pre-approval in hand, it's time for boots on the ground, the house hunt. And just like your lender, you need a real estate agent who understands the VA loan process. A good agent won't just show you houses, they'll be your advocate. They'll understand the VA's minimum property requirements, or MPRs. The VA isn't trying to be difficult with these requirements. They simply want to ensure that the home you're buying with your hard-earned benefit is safe, sound, and sanitary. We're talking about basics. A solid roof that doesn't leak, a functional heating system, no broken windows, no lead-based paint hazards, and no termite damage. A knowledgeable agent can spot potential MPR issues from a mile away, saving you the time, money, and heartache of getting into a contract on a property that the VA will never approve. You've found the one, the perfect house. Now it's time to secure the objective, making an offer. Your agent will help you craft a competitive offer based on the market. But here's where the VA loan gives you a unique and powerful piece of armor. The VA Amendatory Clause, sometimes called the Escape Clause. This is a mandatory clause in your purchase contract that is designed purely to protect you. It states that if the VA appraisal of the home comes in at a value less than the sales price you agreed to, you can walk away from the deal completely without losing your earnest money deposit. Let me say that again. If you agree to buy a house for $300,000, but the VA appraiser says it's only worth $290,000, you can cancel the contract and get your deposit back. No questions asked. This is an incredible safety net that most conventional buyers do not have. Once your offer is accepted, the process moves into the final inspection phase, the VA appraisal and underwriting. The lender will order the appraisal from a VA-certified appraiser in your area. This appraiser has two jobs. First, to determine the fair market value of the property, just like any other appraisal. Second, to act as the VA's eyes on the ground, ensuring the home meets those minimum property requirements we talked about. If the appraiser notes any issues, say, a broken handrail on the stairs or some peeling paint on an older home, they'll note it in the report. Usually, these are minor fixes that the seller can easily take care of before the loan can close. Simultaneously, your loan file is sent to the underwriter. The underwriter is the final decision maker. Their job is to review every single piece of paper, your COE, your income documents, your credit report, the purchase contract, the appraisal, and ensure that everything meets both the lender's guidelines and the VA's guidelines. They are the final quality control check. They might come back with a request for one more bank statement or a letter of explanation for a past credit issue. This is normal. Don't panic. Just provide what they need promptly. Their goal is to get you to the finish line. And then comes the day you've been working towards, mission accomplished. Closing day. You'll go to a title company or an attorney's office and sign a stack of documents that feels a mile high. You'll sign the promissory note, which is your official promise to repay the loan. You'll sign the mortgage or deed of trust, which secures the loan against the property. It can feel overwhelming, but at the end of that signing session, two things happen. The funds are transferred, and a set of keys is placed in your hand. Those aren't just keys to a house. They are keys to a home. They are the tangible result of your service to this country and your diligence in navigating this process. From understanding your eligibility to that final signature, the VA home loan is more than just a mortgage program. It is a promise fulfilled. A thank you from a grateful nation. It's a tool designed to give you, our veterans and service members, a foothold in the American dream of homeownership, a dream you fought to protect for everyone else. It has its own language, its own rules, and its own process, but as you've seen, it's a process you can absolutely conquer. You served our country with honor, courage, and commitment. Now it's time to use the benefit you earned with that same spirit. This isn't just a loan, it's your legacy. Go claim it.